Welcome to the Go-to-Market Navigation by Fiend Capital, our ongoing series where we break down the essential components of nailing the right go-to-market strategy. I'm Daria Davydenko, Chief of Staff at Fiend Capital, where I work across our portfolio to support strategic initiatives, operational scale, and capital planning. Today, I am thrilled to be joined by Pauline Chan from Pilot to talk through one of the most critical yet often misunderstood parts of building a high-growth company, how to manage your cap table and negotiate your valuation. This is such a foundational topic for early-stage founders and one that can shape everything from the team incentives to a long-term fundraising success, and I've been really looking forward to this conversation. Welcome, Pauline.
Hi, everyone. Pauline here. I'm the principal of CFO services at Pilot. Pilot is a growth stage fintech company backed by Sequoia and Index. We help founders from closing the books to filing taxes on a more strategic level on the fractional CFO side, which is where I sit. I've actually had financial experience for more than a decade, spent quite a number of years in investment banking, was at Goldman's TMT investment banking and Morgan Stanley's M&A team. A lot of experience with valuation, helping founders think about M&As, IPOs, and before Pilot, I was actually also a VC investor, invest from C3 Series B, seen thousands of founder pitches, financials. So we'd really love to share my experience with everyone today.
That's awesome. Thank you so much. Well, I guess let's start. Let's dive into some of the questions that we have today for you. So let's start with, the most basic questions, how the companies are valued. So especially in tech. So if you don't mind, just maybe walking us through both like from the venture perspective and M&A lens as well.
Let's start with a public company perspective and how we think about valuation. So this is to demystify what a lot of questions that founders have. And so when you actually go to the M&A stage, investment bankers would use a method, what we call the football field, that would comprise of basically four types of valuation methods. Number one is discounted cash flow, everyone known as DCF. Second is public comparables, public companies that trade similar to you. And then third is what we call the private M&A deal comps that we use. And then the last one is leveraged buyout model, LBOs. And so in the tech industry, the most relevant metrics is actually public comparables and also private deal comps. I would say because a lot of them might not be profitable yet or high growth. And so generally, when we were in investment banking, that's the weekly analysis that we used to do for all of our clients. So this is also very relevant when we come to venture, where how a lot of VCs think about your multiples or how they think about your valuation would directly be relevant to multiples, revenue multiples. And happy to talk about what drives revenue multiples, but I'm going to pause here and see if Daria have any questions.
No, that's awesome. I think, do you have like a favorite, I guess, method to value a company? Like that's the one that you always rely on, or does it really depend on the company?
Yeah, so I actually, to me, there's a three quick back of the envelope way to think about valuations when a founder tell me what their business is. I think like the three would be how a company monetize, their gross margin and revenue growth rate. And how they monetize actually the key metric of that really determines the revenue multiples. And so a more recurring nature of revenue versus a more transactional tick rate usage based can trade very differently. I'll give you an example like Uber, DoorDash, everybody knows is a tick rate marketplace model. Actually, is usually traded between 1 to 3x, 1 to 4x net revenue in the public sense. And for more of a like Adobe, like 90% gross margin, really on recurring revenue, they could be traded in the teens range. And so the magnitude could be actually 3 to 4x depending on how you monetize. Cash is the same, but this is something for founder to think about when you do your pricing model and strategy. And I think the second is on gross margin, where what I mentioned, like Adobe is an example, even OpenAI, that it's the SaaS, what we call the SaaS type of margin in the 70 to 90% range, because that leaves you a lot of room for your fixed costs to operate versus a more like a service type of model in the 50% range. And so that could actually affect valuation yet, as you know. And I would say lastly on revenue growth rate, a lot of VCs really want to see like great revenue growth rate. And so like that is the model that we're looking at. Some investors even look at like a 3x, 3x, 2x type of explosive growth. And so that is also one of the lever. So in public company sense, once you're in $1 billion of revenue, a very healthy metrics is still growing at 30%. But when you're earlier stage, I think the room for growth is actually, it's just more massive.
Yeah, that makes a lot of sense. I know you touched upon OpenAI. Would you mind just quickly maybe walking through the listeners through the OpenAI valuation example?
Yeah, the OpenAI is a very interesting stage and interesting company. So I think number one is they there is a reason why OpenAI offer a subscription model, like where like 90% of the users are actually paying a month to month instead of usage based. That's also why they're valuing a certain multiple. So I would say one of the biggest lever for OpenAI's valuation is actually their explosive revenue growth rate. So I think in the past, I think they started monetizing in 2021, and now they're in 2025. And 2021, they were only making around 20 to 30 millions, and now they're projecting like close to 13 billion this year.
Wow.
And they're growing at 7 or 8 times every single year. And if you think about what I just mentioned for a healthy $1 billion public company growing at 30%, and now when they are last year they reported 3.7 billion revenue at that level, and they're still growing at 7x, 3, 4x. That is what we call explosive growth. And therefore, their multiples that you can imagine is more than the teens that we imagine. It could more so be in the 30, 50x range. It's mostly, I would say, one of the biggest drivers on revenue growth.
When you were a VC, what are some of the great examples where the founders came prepared and were able to position the company with a solid financial framework? Maybe if you could just tell like why you think it's important and what are some of the common mistakes that you see founders make?
I think this is a great question. And so I always say that great founders, they don't just recite metrics, they really explain them. And when I was in VC and very commonly, I'm very impressed with YC founders or some other founders that came that are really experienced or with finance background, they're usually really sharp on metrics. And the most important thing is they can preempt what investors are likely to ask and already explain whether it is like a one-off hiccups, whether it is a more structural trend, and what are the action plans that they already have to rectify those trends. And those are usually the founders that are really pencil sharp, very thoughtful. And so those are, I think, like one of the traits that I've seen that are very very important. And so like example could be like, oh, if their gross margin dropped by 5%, like consistently for 3 months, they should be able to explain whether this is like a one-time like pricing change, or this is like a one-time, or this is like more of a structural change.
Yeah, absolutely agree with you. I feel like that the grounded bottom-up analysis is crucial, and being able to explain to the investor like why your CAC spend is what it is and what are some of the levers you have to maybe improve your CAC spend, and it's going to be really important. So and it just kind of instills confidence in the investors in your company and making sure that you understand what you're doing and what the metrics are showing you and how to drive the company forward. I guess let's move on to some of the common pitfalls that founders should pay attention to when thinking about fundraising. I think it's one of the most important, I guess, work responsibilities that founders have is raising capital for their company. So, what are some common pitfalls that you have seen the founders fall into? And yeah, especially
Yeah,
maybe
I
like
think
early founders.
there are probably like a couple, I would say the three things that I've seen. I think number one is when, especially for first time founder, every investor, they call themselves quote unquote early stage investors, but it can mean pre-seed to seed investors, seed to A to B. They're all early stage, but they're all looking for very different types of metrics, different types of businesses. And so really understanding like this type of different stages of VCs and what their thesis are is very important. And I think like number two is really a lot of them. Some founders they assume like, oh, you talk to an investor and they say no, and then it's like a forever closed door. But actually, if you're too early for a particular investor group, and instead of being disappointed and really thought the door was shut, it's always a great practice to include a potential investor update for everyone that you've spoken to. Because a lot of times on the street, you hear about, oh, wow, who and who got preempted by like some prominent VCs. That's actually because the founders have this like great practice of keeping everyone updated. And when they hit certain metrics, VCs will extend their arm when this is really a fit for their investment thesis. And I think number three is just chasing high valuation without really understanding like the milestones or the metrics that you need to hit. So a lot of times I think founders would really want to figure out whether this might be a short term when you get to that valuation, but if you don't grow into it with the amount that you raise and with the time that you have, this like might actually be what I call like a sword with two edges, where you might actually lose more ownership going down the road when you raise a down round, like potentially. And so really thinking about the right valuation, what market environment you're in, is actually very important. And this is firsthand learning from really real friends, like founder friends.
Yeah, totally. I guess how should the founders think about the cap table construction and investor mix? Are there any best practices or red flags that you could share?
Yeah, so that this cap table strategy is like a really comprehensive topic that we can think about. It's not just about ownership. A lot of times it's like the momentum and whether you can survive with the cap table that you have. So a few things that you want to know, and there are different types of investors. I think number one is what we just mentioned, more of the institutional type of strategic versus financial VC. So you want to know like whether you are getting someone that could be a potential acquirer on the strategic side, or you are getting money from a financial investors that are in it with you and that want to make return. And number two is, especially for healthcare startups, we very constantly see angels investors on the cap table. They're usually really great for early checks and help you get the ground running. But sometimes they can be capped out and they don't usually follow on, especially if you need a lifeline. So there's a certain strategy that you want to really think about it. And I think the third type is family offices can be very flexible, but sometimes can be slower. And a lot of times founders neglect the last type that I'm going to talk about, which is the debt or non-dilutive type of capital. Sometimes when you need to bridge cash flow, it can be very useful. A lot of actually big VCs, they have a separate, like for example, SaaS revenue type of non-dilutive financing. But sometimes founders also need to be cautious with like some of the covenants that it might have and some of the terms of these type of capital. So for cap table construction, it's important to think about what type of investors you take money from, what are the time span that you have with that amount of money raised, what are the next stage milestones that you need to hit, and ultimately think about the signaling risk that you might send to investors. Some investors talk about quote unquote party rounds. Some investors talk about, oh, there are angels that are really strategic. And so the cap table can signal different messaging to investors. So being really thoughtful about it, it's very important.
Yeah, I agree with you, especially about the strategic versus financial VCs. Sometimes some VCs, they're just kind of giving you the check and then, they're less involved with your startup, but then there are others who are actually helping you with go-to-market strategy, thinking through some of the operational items, recruiting. So we at Fin Capital are definitely helping founders through all of those milestones.
Actually, speaking of that, I would say for the institutional type, let me mention strategic financial. I almost always tell founders or close friends that sometimes you want to raise from a really big, like dominant strategic, like more financial VCs. But then I always think it's great to have one or two more like co-investor type of VCs on your cap table, because you are a bigger, like you're a bigger chunk of their whole portfolio. And they actually, a lot of times they were able to introduce your customers. They were able to really help with like hiring, finance. And so having those are actually very, very helpful. And sometimes, especially second time founders, they usually tell me they prefer that, especially in the early stage. And so it's great to know.
Yeah. Could you talk a little bit about the party rounds? What are they? And why are they called party rounds?
Yeah, so usually, well, to a lot of founders, there's something called the power law that you
Yeah,
might hear a lot of VCs, they kept saying the power law. And power law basically means that a small amount of your portfolio is going to generate the majority of the return for your fund. And so for like you can think about like Sequoia of the world, they usually try to buy up ownerships when you continue to raise your Series A, B, C, and so because they foresee that that is going to be the major return of their fund. And so when I say like party round is usually you see 10, 20, 30 investors in one round, and they can be on different, because a lot of founders nowadays use raise on YC saves, and so they can be a pre-money, post-money. And so those generally could mean that, oh, a major investor, they don't want to take up too much ownership and they might not have as high of a conviction versus another investments where they are aggressively trying to push out other investors and want to own more. And so therefore, sometimes you see what we call a clean cap table is like the same investors continue to buy up ownership continuously and progressively on different rounds. And so there is no great or not great. I think party rounds have its own merits versus like the other round, but this is generally how the outside world and how the VCs view a cap table.
got it. What are common mistakes, I guess, have you seen um, with other early stage founders when they're managing their cap tables? Could you maybe share some, examples?
Yeah, so I've worked on a lot of M&As for founders. I've helped them sell to public companies when I'm in pilot, and so I've actually seen a couple of mistakes. I would say the biggest one is one founder. He has never received a couple hundred K a wire from this investors from 3 years ago. And so when we do diligence during M&A and we're trying to match their books versus Carta, and it's not really matching, and that create, you can imagine like a lot of legal questions, a lot of
Yeah,
financial questions. And so I would say really reconcile your cap table like versus your accounting records. And like there are a lot of tools that they're great, but I would say they might not have very good operational hygiene. Ultimately, they're still a tool, a platform. So always reconcile. And I would say some fractional CFOs and out there or some tools that you can use is a lot of founders want to know exit scenarios because when you raise on saves on different caps, valuation caps, you want to know at what valuation that's like the outcome is going to be. And so understanding that is also very, very helpful when you think about your exit.
yeah. I guess another examples, sometimes we come across is when founders they give away too much equity in the pre-seed or seed rounds, either by raising too much capital too soon or mispricing risk or not understanding the implications of large option pools or safe conversion terms, and then that can limit their flexibility on later rounds or leave founders with less than 20% by Series B, which is a tough long-term alignment for the company. And then another one, which is I think is actually pretty crucial, is not setting up a proper option pool early. So either they forgot to do it or they create one that's just way too small. And when it's time to hire top talent for the company to drive growth, they don't have enough room without having to go back to the board or the investors and ask for for additional
It's
option pool.
It's really so generally just for the founders. So every round you expect to lose between 10 to 20%, which is very common because that's what we mentioned. A lot of investors love power law. And so by Series B, if you raise your pre-seed and thinking about like how much ownership you give up, you still want to align your like incentives want your sorry, investors want your incentives to align with them. So they want you to still own a sizable ownership by a later stage. And therefore, if you think about pre-CC, you already lose that amount. And so every subsequent round, you need to lose like 20%. That's like a big ownership stake. And so like what you said, Daria, like thinking about that is so it's so important.
Yeah. Would you, I guess, how would you think about, I mean, speaking about equity, how would you think about equity allocation between founders, early employees, advisors, and investors? I guess, what advice would you give to some of the early stage founders as they're thinking about this?
Yeah, so generally speaking, I think from an investor perspective, they always like to see there is one controlling founders that actually own a stick that they're able to make like decisive like decisions. And so when the scenario came with if there are a lot of co-founders and maybe everyone own the same amount, I think it is a good exercise to think about who are if that person leaves the company might not survive, and therefore carefully thinking about the cap table. It's very important because that goes back to every round you lose 20%. And so you still want to have a founder that can have voting and can decide the company's future. And I think one of the very common example that people don't think of is actually for Google and for Meta. Mark still have like controlling voting rights because they're different share class. And so thinking about really having the voting rights and down the road, it's one of the considerations a founder can think about. And for early employees, I would say it's always important to incentivize your employees or people who work for you in the correct way. Organization design is one of the most important factor of whether the companies can go a long way. And so awarding them accordingly, very important. I think, and VCs, as you know, every round they come in, they want to own 10, 20%. And I would say like finally the advisory share, I would say I would prioritize early employees, co-founders, and VCs first, and then maybe advisors or maybe some other law firms that work on your deal, but definitely prioritize early stage like employees and VCs.
Is there any advice you would give to the first-time founders who are navigating valuation conversations for the first time?
So I always tell founders that I think there are two things. I think number one, in terms of negotiation, always leave it up to the VC to decide. And a lot of experienced founders, they know they would say, let the market decide the valuation. And so this is to generate like a relatively competitive dynamics for VCs to really think hard about the valuation. And but more importantly, for a founder themselves, I always think it's very important to know which public company that you benchmark to and very methodically think about, okay, what are their gross margin? What do they spend operating expenses on sales and marketing and on like professional fees and all the different important drivers so that you know this because perfect public companies a lot of times have perfected the financials. And so you want to know which are your closest role model, competitor that you want to work towards, and then see where you're at. And so from there, you know that, okay, when you're public, when you're at that scale, when you're growing at that rate, that is how they are being valued. That's their revenue multiple. And then compare to yourself and think about what's like a reasonable range. And so I think it's always healthy that you have an internal estimate or a range, and then you see how the investors price you.
Love that. Love that advice. I guess maybe the last question to wrap this up. Would you, I guess, when is it worth giving up more equity for a strategic investor versus optimizing for valuation?
Number one, think about like in what kind of businesses that you're in. Like for example, in healthcare, like I have seen businesses where they think that they're very logical strategic buyers are only two or three big players in the industry. Like in those scenarios, it might actually be worth it that you partner with them early, you started to talk early, so then instead of them talking to your other competitor, which actually did happen when I was in VT. One of our early portfolio got sold to Lyft because there's just competitive dynamics of
Hmm.
whether they will talk to you or talk to your competitor. So I think in that scenario, really think about the pros and cons and talk to the strategic investors early. And I would say in other scenario, you still want VCs to incentivize to invest in you, and there is a power law. And so sometimes if you're doing well and growing at 300%, then you think about whether that is like a right valuation and whether you want to give up more ownership. But if you're not yet cash flow positive, not close to break even and still burning, then there is like a pros and cons in whether you want to get some bridge round, some of the lifeline that we call it, so that you can reach to the next milestones that you want to get. And so in those scenarios, maybe consider giving up ownership. So it is always the pros and cons, and therefore we mentioned knowing your valuation, knowing how you compare to a public company is actually really helpful.
Amazing.
I
Love the advice, and thank you
yeah,
so much for your time.
I wanted to add a last thing, just now when
Yes.
we talked about gross margin and
Yeah.
costs and what is a one-time hiccup, what is structural. I actually have worked with companies where they have a negative gross margin and they didn't know if like you should have a positive gross margin. So eventually when the company scale and your S&M, like your sales and marketing and G&A doesn't account for that much anymore and you can be cash flow positive. And so important to really think more about your gross margin. And I'll give you an example for AI companies, which a lot of them use ChatGPT's model, OpenAI's model. A lot of founders that I've heard, they migrate to open source, and so that they want to get back their gross margin from in the 70% range to 90% range. And so there are different levers that founders can pull on gross margin, and founders should really actively think more about that.
Got it. No, definitely agree with you. The gross margin is very important for the overall health of the company and managing the bottom line. Well, thank you
Awesome.
so much, Pauline. This was amazing conversation. Really enjoyed it.
Likewise.
Yeah, thank you so much for your time today.
No, thank you so much, Daria. I love the conversation. I hope to see more coming and really great chatting today.